Welcome to the Phoenix Prosperity Podcast, where wealth meets legacy. Join your host, Tim Fergestad, as we explore the journeys of Phoenix's finest to success and beyond.
Hello, this is Tim Fergestad. Thank you for joining us. I'm very pleased to have Raman Singh with me here today. Raman is a seasoned certified financial planner, over 14 years in the industry, specializing in helping high-earning individuals navigate the complexities of finances with confidence. As the founder of Singh Private Wealth Management, PWM. All right. Raman provides comprehensive financial planning services, including tax planning, investment strategies, and risk management, all on a flat fee fiduciary basis. Yay. Additionally, Raman operates several businesses, including Craftsman Work Gear, which offers high-quality construction products for roofers and framers. He's dedicated to delivering personalized financial guidance and business solutions, empowering clients to achieve financial goals. So that's a great background to have for a lot of people who, run their own companies. They want somebody who understands what they're dealing with. So that's great. Welcome to the show, Raman.
Tim, thank you. Thank you for the warm introduction. I really appreciate it.
All right, there's a lot there. There's a lot of great stuff. I'm excited for this. Do you want to give us a quick snapshot of where your focus is right now?
Sure, yeah, certainly, Tim. As you mentioned, I've been in the industry for over a decade, and I got just tired of working with the big man, and not necessarily just for the work I was doing, because it was a nice job, 9 to 5, Mondays through Fridays, right. Weekends off. And I chose to disconnect myself from that route and start something on my own, simply because ultimately what matters is taking care of people, right? People are coming up to us or to visit financial planners because they feel helpless. They're not really sure where to begin. They're unaware of the nuances. And think about our wealth or financial health is what I say is the decisions that we make today. It may not necessarily show us the impact that we're making on it today, but it will be long term. And right. Given the fact that there's so much misinformation out there, and a lot of individuals or companies could mask themselves really well and not really look out things for your best interest, is the reason why I decided to start Singh PWM, because I wanted to bring transparency in people's lives, but I wanted to lead with education first. Right. I am Excellent. A student of life, so I lead with education. I want to teach my people, my tribe, my village, my clients that this is how things are done, and you pay me for the value that you're receiving.
Right. There's a lot to know out there. It's a complicated landscape, and a lot of people are not educated about finances. Right. They know their field or their industry, maybe how to make money, but not how to keep it or put it to work for them.
Absolutely.
Okay, so can you, there's a lot there. Can we unpack that a little bit more and talk a little bit about the different types of financial planners and, the traditional, all the way to the newer ones, and different ways they get compensated, some of the pros and cons of that, as well as what sets you apart?
Sure, no, great question. Whenever somebody says the term, I'm a financial advisor, my first question goes in my head is what kind? Just like if somebody says, hey, I'm a doctor, the next question you ask is like, oh, what kind of physician are you? Right. Or I'm a doctor in engineering, or I'm a doctor in, a PhD in XYZ, or I'm actually an internal medicine physician. Right. So the term doctorate literally means that you have a certain type of, education, of course. Unfortunately, the term financial planner is not as secured yet as it should be. Right. So, the way the industry works is depending on where you are in your life, you can go to multiple different advisory firms or financial planning firms, should I say, right? So there's some guys, I'm going to try not to name any of these people or these organizations, but there's some organizations, they'll lead with financial advising, but they will try to sell upfront commission-based products, right? Typically anybody, I wouldn't necessarily say everybody, but Series 7 licensed individuals typically tend to sell commission-based products, right? So I always tell my prospective clients or people that I meet, ask your advisor if they're Series 7 registered or not. I used to have my Series 7 license years ago. I let that go 6-7 years ago because it was not necessary anymore.
Can you give an example of the type of product that you're talking about so people
Yeah,
get an idea?
absolutely. Once again, just because a product is being recommended doesn't necessarily mean it's because of commissions, right? So kind of putting that disclaimer out there. But for example, if I was working for a commission-based organization, right, I will meet with you as a client, I'll give you recommendations, and I'll say, hey, buy this mutual fund. But now, depending on the share class of a mutual fund, A share, for example, specifically, I will get upfront commissions on the mutual funds. Now, mutual funds, they still somewhat exist, but I know ETFs is the more popular way to go. In more cases nowadays, commission-based products would be if an advisor is selling you an annuity, for example, a variable annuity specifically. But the point is, once again, I as a flat fee only planner still would recommend a variable annuity to a client if it's a good fit. But the difference between me and the Series 7 licensed individual is I'm making the recommendation based on your needs and the amount specifically based on your needs and not getting compensated for that. Versus the person who is Series 7 licensed will get compensated. So they might have a conflict of interest where if you have $1 million, they might want to recommend putting in $800,000 in a variable annuity or entire million. Where in my case, when I do planning for my clients, I might recommend, hey, put 30% of the money because of this reasoning. Right. So that kind of sets me apart from those folks.
Okay. A little bit. Well, the term fiduciary is used broadly in a lot of cases. You want to speak on that a little bit?
Yeah. I mean, it's going to be an extreme opinion. I'll say that. So hopefully the listeners and the viewers appreciate that. I personally think the term fiduciary is not fully regulated as it should be. There are several individuals, even CFP professionals like myself, because I'm a CFP professional, where they'll wear their fiduciary hat when they're giving you recommendations and building a portfolio, whatever the case is. Then they'll take the fiduciary hat on and put the salesman hat on. Right. The fact that you could change hats whenever it's
the big conflict of interest.
Big conflict of interest, right? So people ask me a question like, hey, are you a fiduciary? And I just say, yes, but that's not a question you should be asking me. And they kind of get confused, like, what do you mean by that, right? Their head twists, like, like my German Shepherds, when I talk to them, their head twists, right?
Yep.
And I tell them, like, listen, ask the questions to your advisor is like, how do you make money off of me? I'm sure you make money. I literally had somebody said, oh, my advisor doesn't charge me anything. They don't make any money off of me. I'm like, wow, they must have done really good in their life that they don't work for money anymore, right? But the point is, you should always ask your advisor, okay.
Or the other thing is that's weird that the service they're providing isn't worth value that they get compensated at all.
Right, exactly. But the question that people should be asking is like, hey, how do you get compensated? If you're giving me a recommendation, how do you make money, right? Where I, as a fiduciary, I call myself a flat fee fiduciary, right? I'm the FFF, right? The flat fee fiduciary, where I'll say, listen, you pay me directly, right? You pay me directly for the work that I'm doing, and I'll bill you first. I'll tell you, like, this is how much it's going to cost you for my advice, right? So once again, the whole idea is to mitigate conflict of interest as much as possible, and the part that just boggles my mind, Tim, is anybody could be like a college student could graduate as a 20-year-old nowadays, right? Get his or her Series 7 license, and they could call themselves a fiduciary and a financial planner. Isn't that mind-boggling?
Well, it depends on the training they've had, but yeah, they can't have at that age too much personal experience.
Yeah. And side note, I'm a tutor / a teacher. I teach these not even just young individuals who are joining the industry, but even seasoned financial advisors in the industry who are trying to pass their licenses. So this SIE, the Series 6, Series 7, 63, 66, CFP, RICP. So I actually tutor these folks. So I get to see a lot of how these folks are operating their business, although I keep my personal opinions to myself because they're here to ask me for help, right? To help them pass these licenses. And it just sometimes makes me wonder, like, wow, like, you're going to get this license and you're going to be this individual who's going to be giving advice to people. I know I wouldn't come to you for advice because I know your knowledge base. It's the knowledge thing, it matters. And it's very hard to identify. Like, if you put 10 financial planners who are, I like to dress up whenever I can, but if you put 10 financial planners who are bald like me with a beard and wearing the same clothes as I am, how would you differentiate one from another? And the average Joe, unfortunately, or Jill will not be able to differentiate because the industry is so murky, unfortunately.
Sure. So backing up again a little bit on the designations and compensations. So, for example, my understanding is, let's say you're working with a registered representative who works under a dealer broker or broker dealer. And so and then there's registered investment advisors or RIAs over here. And then there's people who are both, right? They have their foot in both, which is kind of what I think you were referring to with, I'm a fiduciary, but I also am over here. And what we mean by that to our listeners is people who work under who are a registered representative, or maybe more of the traditional financial advisor that they may have experienced, who is compensation or is compensated on commission, and they're also restricted in terms of like the menu they can offer you for investments based off of the rules of their license and or the place they're working. So if you wanted to do something alternative to what they're offering, they can't help you. That's called trading away. It's also restricted. They can't, which they may not know about it, so they probably shouldn't be advising you about stuff they don't understand anyway. But that's kind of, I've had that experience where I've had advisors tell me, yeah, oh, that's risky. Yeah, real estate's bad, whatever, things like that. I had to go educate myself elsewhere, but there's commission-based compensation. And then I think a lot of the RIAs do assets under management, right? That's like a percentage fee based, and then you're a flat fee. Can you talk about the different types of fees and maybe fill in anything that I sort of messed up there?
As you're speaking all this stuff, my Series 7 tutoring bells are ringing. Like, oh yeah, that's exactly how I teach these students, right? So the registered representative side of things, it's mostly Series 7 registered, where they don't get paid for advice. So advice is free, but they charge commission on the product, right, to make up the difference. That's the registered representative broker dealer side of things. RIA side of things where I'm at, right? Because I'm not in the dual category, as you mentioned, like some of these big wirehouses are, like Morgan Stanley, Merrill Lynch's, yada, yada, yada. Right. But on the RIA side of things, so traditional RIAs, you could think about like Fisher Investments, right? They're, hey, we make money when you make money type of conversation. But I have a problem with that too.
Well, I'd also like to point out that what you just said, we make money when you make money, that sounds like great alignment. But the truth is if they get paid on a percentage of assets under management. If you have $10 million with them and they're making 1% on that or something, whether your investment goes up or down, they're still getting 1% of what they're in charge of. So you didn't make any money, they still get their fee. So that's not really the alignment I was talking about.
Right. No, exactly. 100%. And the thing is, a lot of investment managers, they mask themselves as financial planners. The problem is the word financial planner. What is that? Like, what is a financial planner? I met my cousin came in town and I met some of his doctor buddies, right? His doctor buddy's 40 years old, makes really good money as a physician here in Arizona. And he goes, Raman, why would I hire a financial advisor when I can just buy the S&P 500? And my response to him was, that is not what I do as a financial advisor. I was like, you can buy the S&P 500, but that's not financial planning, right? Financial planning is beyond investments. Like if you look at the pillars of comprehensive planning, investments is like one of the 6 pillars basically of financial planning, right? So to give you an idea, that 1% fee, in my opinion, is nonsense, right? If I'm sitting here just managing investment portfolio and building ETF portfolios, and that's all I'm doing, why am I charging why am I charging 10 grand a year just to click 4 buttons 4 times a year?
Right. You're grabbing some index.
Right, exactly. You're just following. I mean, I can literally tell somebody like, yeah, I'll build an ETF portfolio for you and I'll rebalance it quarterly, pay me 1%. I mean, that just, it just doesn't add up to me because once again, I've been in the field. I'm seeing it. I'm the one who's done rebalancing in my career for clients. That's why I tell my clients, when you go to someone's nice office and they give you the Fiji bottled water or they have, a nice car coming in, the nice suit, you're paying for all that, right? That's why your fees are high, right? So to answer your question, the RIA world is saying, hey, you know what? Don't go to the commission side of things. Come to the AUM side of things. We make money when you make money. However, I still think that there's a huge controversy with that, because what else as you as a financial planner, if that's what you are doing for the client, right? If it's just managing investment, I'll tell a client any day, if all you want is just get your money managed, go to a robo-advisor. Go to a robo-advisor because they'll just manage your money. You're gonna save yourself fees right away, like 30 basis points for $1 million, maybe less than that, right? But if you want a comprehensive planning, now that part changes, right? So I, as a RIA financial planner, a flat fee fiduciary, what I do for my clients is, okay, depending on what stage of life you're in. So for example, I have a client who wants to retire at age 62. He needs a controlled distribution annualized. On top of that, I need to do annualized Roth conversions for him, right? That's just the two bare minimum things. Then on top of that, Medicare is about 3 years away, helping them, making sure they're aligned for Medicare. Once Medicare's into the equation, annualized Roth conversions while making sure that they don't go over the IRMA premium or get hit with IRMA premiums. And then also planning out for long-term care strategies around that on top of rebalancing. So there's a lot more happening cohesively.
Right.
And my client had monies at Motley Fool, and they were paying 1%, and then these Motley Fool portfolios looked very fancy. And I broke the portfolio apart in a matter of like minutes, basically, for the client. I showed him the full analysis. And they were paying on a $3 million about 1%, so that's 30 grand a year. And I set the right expectations for the client, and I told him, like, listen, what do you want? How can I help? Raman, I want to do annual Roth conversions. I want you to run a retirement analysis for me. And I would like to make sure that, portfolios is rebalances properly and everything. I did my calculation. The fee for them dropped down to 10 grand. Because I told them, like, I don't have a fancy office. You're going to see me virtually, right? We'll have conversation whenever you want to. You could text me on my phone whenever you want to. But based on the work that I'm putting in is the fee you're going to pay for that, basically. If I'm doing more work, the fee will go up at that point.
Right. Right. But your time has a certain value, and as you get better and wiser and are providing more value, you charge more for it. But it's not based off of their money, whether or not you're providing the same service for somebody if they have 1 million, 10 million, 50 million.
Yeah. So my average client is about 3 million investable assets, net worth of about 5 million or more. Unless I'm working with Henrys, and my Henry clients, on an average, they earn about 350 grand a year. They're on the younger side of things.
I imagine one of the challenges of being more fee-based instead of percentage of assets under management is they see an actual bill. So they're like, wait a minute. Whereas before it was hidden. They were paying a lot more, but it was hidden, and so they didn't understand. And is that true? Can you talk about that a little bit?
That's the thing, right? The commission-based side of things was that you never see a commission. It's just like, oh, I didn't pay any fee. My financial advisor is so nice. He doesn't even work for money, right? He just does great stuff for me. Fee only, the percentage of fee, because remember, fee only could also still be percentage of AUM.
Okay.
Right? The only difference is when I say I'm fee only, I can charge percentage of AUM, just like Fisher Investments. Say they're fee only, they'll charge percentage of AUM. For these guys, like I said, you could see fees, but the thing is the fees will fluctuate on a quarterly basis, but there's a full calculation around that. And the easiest way, I'm not saying it's going to be precise, 100% accurate, but the easiest way to look at it is the entire annualized statements, and then take a look at when the fees were deducted and add it all up and divide it by the account value. Now, that is not the precise way to calculate, but it gives you a ballpark figure on how much you're paying on an average in fees. Right, there might be a discrepancy by, I'd say, 10% plus or minus, right? Okay. But it's, with flat fee, now I am a flat fee, right? So where I'm a fee only, but I'm a flat fee only. My clients will literally get a bill for $2,500 for the quarter, right? Doesn't matter if the account went up to 11 million or if it went down to $9 million, it's $2,500 because I'm leading with planning, right?
Right.
I am sitting here doing planning for them. I'm like my ultra high net worth clients, I'm having conversations about what if the estate tax reduction happens, the estate tax exemption happens. We need to perhaps take advantage of some of the estate exemption now and put it inside a B trust, right? So we can disinherit some of the money and allow it to grow estate tax free, basically. So these are the conversations we're having outside of just money management.
Sure. Okay. I imagine also being flat fee would help with some types of investment alternatives for your clients. For example, one of the challenges I have when I work with some investment advisors, RIAs, for example, when they are percentage, they want my investment opportunity on their platform so they can track it and be compensated for it. So even though I have a great investment opportunity for their clients, they won't advise their clients to invest in it because it isn't easy for them to get compensated for it. Right? Which again is a conflict of interest, because if it's best for the client, they should do
Why
it.
aren't you doing it? Yeah, exactly. It's kind of why aren't you?
So, and a lot of our deals, we're kind of in that weird space. So some of our deals are available. We can put them on that platform, but it's a lot of time and energy on our part, and we don't need to, right? But a lot of our deals are fast. Real estate gets SEC exemptions and stuff through Reg D and stuff for a reason, because otherwise we wouldn't be able to transact through the modern financial criteria and regulations. So we can't offer those to a lot of them. It takes a long time to get it on their platform. By then we've already closed on the deal and we're on to the next one, type of thing. So can you speak to that, and how have you had any experience with that about how some RIAs there's big ones, right? People want real estate in their portfolio to say, oh yeah, we'll give you invest in a REIT or something like that, something public, which doesn't have a lot of the benefits.
Yeah, I mean,
it's a real estate flavored stock.
It's funny you say that. I feel like the industry is at a point, it's no different than working, with doctors, basically, right? So like, for example, if you want to go see a doctor, Tim, what type of doctor would you prefer to go to? The one who works in a hospital, or the one who's in a bigger group, who's under the hospital? Or you want to work with somebody who has a private full practice and they get to know you by your name, right? That's the first thing that people need to start differentiating working with financial advisors. The guy who's working with the big hospital, he or she is limited with what they can tell you, right? That's the big RIAs, like you mentioned, or the big broker dealers that you mentioned, right? They're gonna be like, listen, if we're not making any money on it, don't waste our time. We don't care. Yes, we're a fiduciary, but not fiduciary enough, I guess. Where the mid-sized, physicians, where they kind of cohesively built an RIA in our case, right? But they're still all about, with them, what's in it for me. Right. The independent side of doctors, where they'll say, hey, listen, like, this is what you need to be doing, Tim. Go see this doctor. Tell him I referred you over to them. He's a friend of mine. Don't worry about it. Like, I've known this guy for blah, blah, many years, but he'll take care of you. That independent doctor is so busy working with his own clientele. He doesn't necessarily care about anything extra on top of that. This person, the reason people go independent with medicine and financial planning is not because we're trying to make $1 million a year. It's not like we're trying to catch all the assets and be in this asset chasing high, right? We want to have a quality of life, and we want to take care of people, and we're not, as we call it, the word is called lifestyle practice is the term, right? Okay. So to me, I care about, number one is, hey, what does the client need, and can I help them get this value? Ideally, yes, I would like for that type of value to be delivered through the custodian that I'm using, ideally. But if not, if, for example, Oak Street Assets does make sense for my clients, my whole goal is to disclose that. Like, hey, I met Tim. We did a podcast together. I liked what Tim has to offer with, alternative side of things with investments. I feel confident that we can leave our assets at where Tim is having assets custodian, right? Because that's where my relationship and my due diligence as a financial planner comes in. But it should not have any negative effect or positive effect on me whether my clients take the assets over to Oak Street Assets or not, right? And that's the true level of fiduciary. I literally had a client move some money over to Robinhood because he wanted to take advantage of the 5%, they were offering like a 5% match if you move money over.
Oh, right.
The client still pays me his planning fee, right? I still have like a small portfolio for him, but I'm like, hey, listen, if you want to do that, do it for 5 years, and then we'll decide what we need to do at that point.
Okay.
Okay.
What you just said reminds me is the premise or maybe thesis of Jerry Maguire movie, right? It was better service, less money. It was sort of like, what wasn't it? There's something to that effect. I don't remember the exact take home, but right. Tom Cruise's character was yeah, we got to dial back the grind and do a better job, do less better.
Yeah, I mean, exactly, right. I got so sick and tired of the industry, I thought about leaving. I was like, I can't be around these folks who are just, the Wolf of Wall Street type of vibe, and just, always just focusing on assets, man, assets. It's just, it didn't pique my
Your
interest.
book,
That's
your
not what my
book.
value
How,
was.
how big's your book?
Yeah, how big is your book, man? Oh, that's it. Like, I've literally had, people talk about crushing competition, growing my book. And I'm kind of like, but where in that value are you talking about? Like, hey, like I really helped that woman out who had lost all the hope, right?
Right.
Because that's what's gonna make me feel, amazing about the work that I do.
Right.
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 Like I say, like value comes first at the end of the day, and everything else just speaks for itself.
Right. I would say I'd like to point out that I was doing hand gestures. I think I had brokers over here and RAs over here or whatever, but there has been growth in this area, right? There's been a shift over the past, I don't know, decade or so, would you say? And why is that? I imagine it's because the appetite for people for more alternative investments. And the word alternative means not stocks and bonds, basically, right? So in fact, some of the biggest, savviest investors have most of their portfolio in alternatives, which kind of makes alternative the mainstream. But can you speak to that? If the appetite for alternatives is really what's driving the industry changes?
I mean, the thing is this, if you look at some, Ameriprise, for example, they can give you the alternative space through their side as well. So they've done a good job at it. And because they're kind of on the both side of fields, right? The RI and the BD side of the field. I feel like the primary reason why advisors are leaving the broker dealer side of the world and joining the RIA side of the world is because they're truly understanding that the commission-based model is not a long-term solution for them, because people are getting more educated, more aware of it. So now they have to make that shift and realizing like, oh, we can't really just keep ourselves hidden from these commissions. We actually have to like do work. And not
They're really hard to find. You say hidden, man. Have you ever looked at some of the
I mean, I
documents
find
to see that?
I'll give you a perfect example. This was in my last job. It was this couple who had like a SEP IRA with full of American funds, because American funds is really big into SEP IRAs, and they were investing in American funds portfolio for the last, I want to say like 10 plus years, because they were contributing into their SEP IRAs. And I told them, like, you're paying 5.5, I think it was like 5.25% commission structure on every deposit that they were making over the last 10 or 15 years. Wow. And they're like, how do we know that? I'm like, okay. So then I have to like pull up multiple resources, pull up the prospectus and show them the symbols and how that works. And it was just, and like they felt so defeated after that. I'm like, I'm sorry.
Not upfront.
Yeah. I was like, I'm sorry you feel that way. I was like, it sucks, but the industry hasn't done a good job to teach you this stuff.
Right. And particularly a lot of it is with retirement funds, right? Through 401ks and other stuff. You have no idea, right? You just designate 80-20 aggressive, whatever, and you send it off.
Target date funds are so expensive now, Tim. Like, I mean, I actually, so I sometimes do one-time plans for clients when they're like, hey, I don't know you. Can you do, like, I don't want to move my money over to you because I don't know what type of work you do. Sure. And I'll charge them a one-time plan fee. And I had a client, New River, Arizona, and hey, we're thinking about retiring. Can you look at our investment portfolio? Target date funds. You would say like, okay, Vanguard target date funds. But because they had about close to $2 million in their target date funds, when I did the math, they were paying close to, I want to say like $8,000 a year in just, 12B1 fees, because it's a target date fund. And I told her, I was like, listen, I can just rebalance this portfolio for you in individualized funds that are, Vanguard ETFs or Vanguard index funds. And I dropped the expense ratio down from, I believe it was like 0.37%, down to 0.10%. And I told her, anytime you want to do rebalancing, just, pay me $1,000 or whatever that amount is. I'll rebalance it for you. You'll still end up paying lesser in fees just by, having this portfolio versus, target date funds. It's just, you got to look that stuff up, man. Like, I mean, unless you're embedded into this information and you're studying it and you're a master at it, or you love studying this stuff, it's not easy. It's not easy.
Right. So what do people, what's one of the first things you can do for people, right? And somebody who comes up to you who who they're already with somebody, but they're not happy. Do you have sort of an introductory sort of call where you offer, right, some sort of preliminary suggestions and stuff?
Yeah, no, great question.
How do they reach out to you, and how does that work?
So some people, they just want to, interview me or talk to me, and I tell them just go to my website, right? My website, I actually changed my website name to raman-singh.com because you work with Raman Singh, right? On my website, it's a report card that you can actually get a report card done for your comprehensive financial well-being. I call it the financial blood work report or the financial vitals report. So people could literally complete that financial vitals report, and I can give them some overview of their comprehensive finances, their financial planning. If they want to do one step further, then they have to enter in with their holdings in the portfolio. Then I could review their holdings of their portfolio. Right. Typically, people, when they're interested in really working with me after they've seen the vitals report, they'll show me their portfolio, and I can pinpoint just by looking at the portfolio what the problem could be, right? Hey, are you taking too much risk? Should you be taking this much risk? How much are you paying in fees? What's the alternative, right? Can you rebalance your portfolio by reducing your risk while not mitigating your return? So these are some of the things that I can immediately give some of my clients, prospective clients, so they're aware of what they currently have versus, what their options are, basically.
Right. I was just making a note that I'm going to have like a separate presentation with you, I think, on retirement planning for people and stuff. And if you're up for it, because I think there's a lot of value that we could keep talking about, for sure. And I also very much like your analogies to the healthcare industry, right? There's a lot of
I have a few doctor clients,
but it's a good analogy, right? For the different tiers of physicians, but also the compensation structures, all of it. So as we wrap up the interview right now, can you talk about any plans or initiatives, things you're excited about in the future in the next 6 to 12 months?
Yeah. In the next, I'd say 12 months, my goal is to cap my practice. So I'm just waiting on my website to say wait list, like, enter your name for the wait list. Right. Because my company's name is Singh PWM, and the reason I decided to make the name Private Wealth Management, even though I'm not like your traditional private wealth management firm, is because I want people to get the experience of what they should as a private wealth management firm. So majority of my initiative with my clientele is simply put, I want to be the Fitbit of their finances. So they're going to be receiving constant reports on their finances, not just related to their investment allocation, right? So I can continue to bring awareness to my clients. So I'm actually working on designing my practice where even if my clients are not meeting with me they're meeting with me every 3-4 months, they're getting constant monthly updates on their comprehensive view of their finances, from the financial vitals, their investment allocation. If some of them, they want more awareness of their spending, how their cash flow is, they'll get monthly reporting on their cash flow, because I want people to know that even though Raman and I haven't met in the last 3 months, I'm getting reporting of all my financial health. And then if I know that Raman will provide me an alert if something is drifting away from my financial health, one of the elements. So that's pretty much what I'm working on at the moment.
Okay, excellent. So if people want to learn more or connect with you, the website, raman-singh.com. Was there any other LinkedIn? Is there anywhere else they should look for you?
People could just look up Raman, your CFO, and I put a lot of short video content out there. It's been a few weeks since I haven't, because I'm we're expecting a baby, we're trying to move, so a lot of stuff is happening in life at the moment. But I will start adding content back on. But my content itself, I would tell people, like, please go listen to it. You will find value immediately by just watching my content, because it's educational stuff and it's very short. So you don't have to spend like 30 minutes watching a video, try to get value for it. 60 seconds or less, you'll get some value on things what you should be looking at, basically from financial well-being perspective. So Raman, your CFO.
Excellent. So chief financial officer, but you're also a CFP.
Yep, I'm also a CFP. Yep.
Yeah, certified financial planner. So investment industry loves their acronyms.
Yeah, absolutely. I couldn't write the word CFP in my taglines because the CFP board has a big no-no about adding the word CFP in anything outside of your name. So the only time I can have the word CFP is next to my name with the comma and the R, the registered logo,
the trademark, right?
Yeah. So I went with my title is called your personalized CFO, because I'm not your financial advisor. I'm your personalized CFO, because I'm going to look at every component of your finances and not just your investments. And I work as your CFO, where when we talk about finances, we're going to cover every single ground where money touches in your life.
Okay, excellent. Very comprehensive. Love it. All right. Well, thank you for listening and watching today. Thank you very much, Raman Singh, for joining me today. We appreciate you sharing your story and insights into success and impact.
It's been a pleasure, Tim. Thank you.
Inspired by our guests? Visit phoenixprosperitypodcast.com/guest and join us on the show and share your success story with Tim. The spotlight awaits.